Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. We're coming to you directly from Duquesne Hall in the Duquesne Family Studio, right here in the heart of Foggy Bottom, the George Washington University School of Business. This is a GW Investment Institute show. Welcome back to anybody that's been watching on YouTube and listening on Apple or Spotify. Thank you very much. And again, welcome to any new viewers. So what are we going to talk about today? Today, we're going to talk about a portfolio company. If you've been following the show, you know that we use the GW Investment Institute framework to break down some of our portfolio companies. Disclaimer, this is entertainment purposes and educational purposes only. The framework is business, management, price valuation, and balance sheet, BMPB. You can see one of our blogs or listen to one of our old episodes about the framework. We've been using this, and our students have been using this now for over 20 years with success. And you can check our website and see some of their quarterly letters as well, and subscribe, by the way, to our newsletter. All right, so what's been happening in the markets? Well, the markets have been up. But today, we're going to talk about a specific company in our portfolio. We're going to talk about Adobe. So we've owned Adobe, and we've owned it for a while. The ticker is ADBE. Now, many of you know this company, and you've interacted with its products. So obviously, if you've ever opened a PDF, you've probably interacted with Adobe. But maybe you don't have a subscription. That's the vast majority of their revenue. So let's jump in to this company. Let's jump into Adobe. And how they make money, and some of their numbers. All right, so first, let's get a sense. We always try to tackle the market cap first. How big is this company, right? What's the market cap? So we're in late July here. Market cap, $158 billion. So this is a large company, but again, not the NVIDIA large company, not the Microsoft, not the Amazons, not the $1 trillion market cap, but still a very large company, $158 billion market caps company. And so let's look at the financials here. Let's start breaking down on the revenue side. But first, maybe we just detail that most of the money is through subscriptions, right? The vast majority, over 90% of their money, Adobe Creative Cloud is that. So if you have that, right, Photoshop is one of the premier products that they have for publishing and advertising. People are in that business. The digital experience. All kinds of different products that Adobe has in that suite of products, and now they shifted, not recently, but not that long ago, from the licensing to the subscription model, and that has really worked, and that has been the growth. That has been the biggest part of the revenue now for a while, and again, over 90%, really probably over 95% of their revenue is coming in from subscription based, which is great. And that's where you can get a higher multiple with subscription revenue. And so that Creative Cloud suite of products, that's really what's in there. And then their AI piece, which is Firefly. I think that's really important, and we'll talk a little bit more about that. So that's the business. That's the products they have. You probably use some of their products. You might have Creative Cloud yourself and use some of those products, if not all of those products, at one point or another. Depends where you are in the business. For your business or working within a business. But now let's look at the revenue here. Again, market cap $158 billion. So let's look at the revenue. So last reported numbers we have, they actually have a calendar year 12/1 or 11/29, depending on when it falls. So it's the 5/30 is the latest data that we have. So that's May 30, 2025. So what's the revenue look like for that? $22.6 billion. So what's the growth on that number? 10%. And what are our projections? So again, one of the things that we care about is obviously where the company has come from, only as it pertains to what we think now and how it informs our decisions. Is there a catalyst? Is there something that's going to change that's going to help us make a decision about what we do today, about the 2 years out, 3 years out, 5 years out, what we think the company's going to do. So if you look at the projection here for 2025 full year, which is 11/30 again, for them, $23.5 billion, 9.6 growth rate, $25.8 billion for the next year in 26, 11/30, 26, 9.5. So these are not tremendous growth rates, right? But it's a huge company. $22 billion in revenue is a lot of revenue. And so when you talk about you get to these big numbers, obviously it's harder to grow those numbers at that scale. And so, but let's now look at where they came from, just to have some context. So 21, you were at 15.7 billion, and 22, 17.6, 23, 19.4, 24, 21.5, and then again, we said 22.6 for the 530 number, the full year projected at 23.5 for 25, and 25.8 for 26. And you're talking, you had better growth rates in the beginning there, 22%, then they fell to 11.5 and from 21 to 22, and then 10.2 and 23, and 10.8 and 24, and 10.6. So, dropping down, now they're below single digits in the projection, 9.6 and 9.5 for the full year this year and for 26. All right. So when we think about, when we're starting to think what's, scoring for the business just on the revenue side, well, first, the compilation of the revenue. SaaS business, that's great. More than 95% of their revenue coming in from subscription-based revenue. People saying, I want all of the Creative Cloud, or I want this portion of the Creative Cloud, and buying that on a reoccurring basis. That is great revenue to have. It's very sticky. People keep resubscribing. It's not a one-time purchase, and then you got to worry about a product or a service refresh. It is a ongoing feature. That's great. And so when we get to valuation, you can get a higher multiple for that number, generally speaking. So, but we'll talk about that when we get to the price valuation. But again, good business model, good revenue numbers, declining growth rates. Okay, but we have to put that all into context. Next up here, what are the margins? So we saw declining revenue growth here, not declining revenue growth. Gross margins for this business, this will be in the exceptional category, 89.2% for 530. So what's that been over time? Is this an outlier? No, you go back in 21, 88, 22, 87, 23, 87, 88. This is software as a service. That's why it's such a great business, right? Your cost of delivery, the marginal unit, zero effectively, or very close to it, depending on how you're going to count it. And the projected to stay at 89.9, 89.8, 25, and 26 respectively. So that's fantastic. So gross margins are very good, have been very good, continue to be very good, projected to be very good. All that's great. What's happening on the net margin? Well, 21. Well, so let's get where they are now. 30. That's fantastic. So 30% net margins, very good business. So let's go back and think about what's happening before. If you look at 21, 30% gross margins, 22, 27, 28, and 23, 29 and 24, 30. They're picking back up, very good. And then 37 and 37 projected for full year 25 and 26. So that's good news. So you see on the top line, we've had a decline in the growth rate. So the top line's growing from 20 projected through May to go to from 22.6 to 23.5, and that's a 9.6 overall growth rate year over year. But that's a decline, right, in the growth. It was 10 plus, a little bit more. Now it's dipping below that. So again, revenue growth, but at a declining rate. So second derivative lower. But our gross margins remain super strong, near 90%. This is sort of in the category by itself, or rarefied air. This is above NVIDIA. This is above Visa, for example. Some of the other companies we've talked about. So the very rarefied air. So again, when you collect 90+% of your revenue as a SaaS model, cost of delivery, very cheap, right? Very good business. And now they're integrating this Firefly, this agentic AI into their business, and people are using that. Also high margin business as well, and likely has something to do with the increased net margins moving forward, or the projected net margins moving forward. So that's all very good. And when you think about, okay, well, how can you have this? Well, cost of delivery, and then, but let's look at free cash flow and CapEx as well in the business. So when you talk about, okay, well, what's the CapEx in the business? So this year, 178 million. So these are not enormous numbers to be putting into this business. And so if this is very capital light, right, you're going to generate cash flow from operations of projected 9.6 or through 530 rather, 9.6 and 178 million rather, very big difference in CapEx. That's nothing, right? And then so you're generating a lot of free cash flow. This business, 9.4 billion in free cash flow, very good. And if you go back You're talking about the largest year in the past, 348 million in capex in 21, and that's been, in 20, that's in 21 and 22 for 442 million. So these are not huge numbers compared to the size of this business. So they're generating a lot of free cash flow. So if you look back, 6.8 billion of free cash flow in 21, 7.3 billion in 22, 6.9 in 23, 7.8 in 24, 9.4, 530 2025, projected 9.2, and capex going to projected at 271 million, and then 328 million the next year, with 10 billion in free cash flow, and their full year 11/30/26. So very good. Those metrics are fantastic, right? Capital light business. You're putting in, even let's look out again. What do we think is going to happen in the future? 2026, 328 million that we're going to have to put in this business, and it's going to pump out 10 billion in free cash flow. Well, that's a great business. If you don't look at anything else, you just look at those numbers. And so business-wise, right now, there are some challenges, right? And so what's going to happen in the agentic AI world, they have their own Firefly, and there are certainly threats to their business and competition, from people like Microsoft, which are big players, right? And then some piecemeal players, depending on what service that you're using or product that you're using. And so there is real competition, and it is up to the management team to figure that out. But right now, even with those threats, probably giving this business an 8. I would give it a 9, or probably never, not sure we'll ever give anybody a 10, but 9.5, sometimes 10, maybe. But giving this an 8 and not a 9 because of the threats, right? What's happening? And until we really figure out, as analysts, as business people, and certainly our students need to figure this out, these threats, I think, are real threats. They seem to have their own version, obviously, or they do rather, on Firefly, on the agentic AI piece. Are they going to outcompete? Are they going to be able to keep their market share? Time will tell, and something we'll have to watch, and something we have to make decisions on. And so I'd say a solid 8 on the business. All right, next up, management. Shantanu Narayen, and I'm sure I didn't pronounce that right, but has been with the business 2017, really fantastic, led the transition to this subscription-based model. They haven't done really big acquisitions, but they've done smart acquisitions, Frame.io as an example on the video side. So really high scores here for managing that business. And if you look at those gross margins and you look at those net margins, you look at the deployment of the agentic AI with Firefly, and the uptake with their customers with that, that's all very good. He's been there, so you have a steady person, almost 8.5 years. He's been there since 2017, so that's very good. And so giving management a very good score here on the capital allocation. They've been very smart. They've been very disciplined. They haven't gone out and bought, a bunch of crazy properties. They've been, the tuck-in acquisitions, more or less, of what they have done to supplement, again, Frame.io on the video side, some small ones on the AI side. So I think they've been very disciplined around capital allocation, and they've been very disciplined on the costs and the right amount of capex. And so really high scores here for management for running the business, especially for transitioning the business, from the one-off license to the subscription model. Again, over 90% of the business is that way right now. And so very good management. You can probably give an 8 or a 9 here for management. Again, strong capital allocation skills, maintain very good on cost control, disciplined capital allocation on acquisitions, as well as capex and growing the business. And so 8 here for the management. All right. Moving on to the price valuation. Now, we talked about, what's happening. You have these crazy numbers. You have 90% gross margins. You have 30% net margins right now. You would think, okay, this deserves a really high multiple. And right now, that is absolutely not the case. So if you look at the forward PE, you're trading at 18 times. And so this certainly says that the market has concerns about Adobe and its way forward. And if you look at, okay, where does that really show up? Well, it shows up in the growth rates, right? Again, top line revenue growth is projected, but that second derivative, which is the growth rate, is slowed down, right? And now it's going down to single digits. And I think another big concern, which we mentioned when talking about the business, is what's happening with the AI world. They certainly have Firefly, and they have their tools in agentic AI, and they have made great progress there. But the market's seemingly on the valuation side is not giving them a lot of credit for that. So I think the market will need to see more progress there. But this company is not expensive, 18 times. The market's trading closer to 23 times the S&P. So that's well below that. And if you look at Autodesk, as partly a competitor, right, on one aspect, they're trading at 50 times as an example, rounding it. And so not expensive, but real threats are in there. Something that you have to be concerned about is how they make this transition from where they are now to this agentic AI world. And are people just going to leave this platform? They certainly have a good creator base, good loyal customers. But does the price override all of that? And even if they can keep some of those customers, does it really hurt their margins over time and hurt their revenue? Their revenue numbers and growth. Certainly, it's already showing up. That's really important. And I think Figma is another competitor that you should be aware of as well. And so, but that valuation, it's certainly not expensive. And so we own it. And so it'll be up to our analysts to figure this out for this fall for the GW Investment Institute. Excuse me. And where does it sit in our portfolio, and how much we should have invested in this company, how much we're concerned about that. Again, on the business side, they're definitely making progress. And to give them credit, to give the current management team credit as well, they did make the transition from licensing to subscription. Now, can they make this transition from pre-AI world to post-AI world and carve out their space and keep their territory, and importantly, reestablish some growth and keep those high gross margins and elevate those net margins? I think that's going to be super important. So when you talk about the valuation, you can probably give the valuation, again, you're about 18 times on the forward. You can probably actually give this a 7. So not bad at all. All right, so let's move on to the balance sheet, and then we'll pull everything together here at the end. All right, so balance sheet here. The balance sheet, no huge concerns at the moment. So if you look at the balance sheet, cash and cash equivalents at 530, you're talking about 5.7 billion and 6.5 billion of debt. So really, but let's use a round number, about $1 billion of net debt here. Not a huge concern, right? If you made it 5.5 and 6.5, about $1 billion in net debt, rounding it for ease. So, on a generating 9.4 billion of free cash flow and projected 9.2 for the full year, $1 billion in net debt, really not concerned, right? And so with those high gross margins, those high net margins, and low capex and generating lots of free cash flow, not super concerned there. You'd like to have net cash, generally speaking, for the investment institute companies. We certainly prefer that. It's something that we helps us sleep at night. But this balance sheet, you're sleeping okay at night, not too concerned. And one of the other metrics that we like to check is what's the interest coverage ratio, right? If they have debt, interest coverage ratio here about 40 times. So we like 10 plus for our companies, and in this case, they're about 39.9 right now. So 40 times interest coverage ratio, and remember that's EBIT, interest before interest and tax, over interest expense. And so how much earnings do they have to cover their interest expense? About 40 times right now. So really not worried about that. So we're sleeping okay at night with this company and its balance sheet. Love to see them in a better position. And if, again, we look at the balance sheet over time, they've been fairly responsible management. You can say that. Cash and cash equivalents in 21 was 5.7, 2021, and 4.6 in debt. And so kind of the reverse situation of where they are now, let's say about $1 billion in net cash then. And then 22, 6 and 4. And so cash and debt. So cash, net cash position, and then 7 and 4 in 23. So net cash. and then 7 and 6, cash and debt. So net cash. And so really, it's just recently that they've gone to this net debt position. But again, high interest coverage ratio, not super concerned. So sleeping okay at night. One of the things that we're watching is this. And so we'll give the balance sheet an 8, maybe an 8.5 here for that. And so, again, good, like it to be, slightly better, but good. And again, generating a ton of free cash flow, not really worried, 8.5. All right, so let's pull it all together. So on the business side, we're going to give, we might revise some of these scores here, but on the business side, let's actually ding them a little bit more. Worried about the threats. That's a 7. The management, I'd say, is an 8. Good things to watch for. They have another big transition to make on the AI front. On the valuation side, I think that's a solid 7 again, with some concerns. Certainly cheap. It could be cheap for a reason. And on the balance sheet, let's say 8. So overall, we could probably give them 7.5, depending on how you want to settle the scores. And I would really probably push that down to a 7 and make the scores reflect that. And so I would probably be conservative on all of those scores a little bit more. Why is that? Why would I do that? Well, concerns about, and the things that we should be looking for, and the things that we need to have our analysts check out is what's happening on the business side. You have declining growth rate on the revenue, something that we need to be concerned about. The other piece is the agentic AI. They have deployed that. Firefly is good, is working. Customers are picking it up, but lots of competition out there, including from people like Microsoft. And so heavy hitters that they're going up against, got to watch out for that. Next up here is, do people just leave the platform and because they get picked off, not just for Microsoft, but all these other smaller competitors? And so you certainly got to worry about the big ones. You got to worry about the small ones. And then I think that's something to look out for. The other part is, how are they going to grow this business on the top line? Just in general, is it going to be through acquisition? Are they going to go out there and buy companies? And so we really got to watch the capital allocation from management on that. Balance sheet, not a huge concern, but something to watch. So that's what we need to look out for Adobe. Again, portfolio company for the GW Investment Institute. Our analysts will be checking it out and checking out some of those concerns, but some of those opportunities in our portfolio. We'll see what happens this fall as the semester gets started pretty soon. Thank you for watching this episode for Market News with Rodney Lake. We'll see you on the next one. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.